Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today we're going to discuss basic accounting and tax issues surrounding trusts. Trusts are established under state law through a private contract or by will. Trusts can be categorized as either living or testamentary trusts. Living trusts can further be categorized as either revocable or irrevocable, and many special purpose trusts also exist. Within the tax law, trusts are categorized as either simple or complex, and either grantor or non-grantor. Simple trusts are required to distribute all of their income to beneficiaries each year, whereas complex trusts can allocate some of their income to principal based on state law. Grantor trusts are ignored for trust accounting purposes. The income is simply reported on the grantor's tax return. Most trusts are non-grantor type and must file a Form 1041 with the IRS each year. The Uniform Principal and Income Act has been adopted by many states and attempts to allocate income earned, such as interest, dividends, and capital gains, between income and principal. It's important to note that there can often be large differences between the accounting income and the taxable income on a tax return. Under the tax law, fiduciaries of trusts must file a Form 1041 with the IRS each year if the trust has gross income of over $300 for simple trusts or over $600 for complex trusts. Most trusts must use the calendar year ending December 31st and must file their taxes by April 15th. However, an extension is available on Form 7004 for 5.5 months, making the trust returns due September 30th. Listed on the screen are some common trust deductions, the most important of which is the income distribution deduction, which allows fiduciaries to deduct from the taxable income of the trust any money that is distributed to the beneficiaries, so that the trust only pays taxes on money that is withheld within the trust. By way of an illustration, let's take the example of a complex, non-grantor, irrevocable inter vivos trust with long-term capital gains of $15,000 that the trustee wishes to allocate to the principal. There are dividends of $50,000, tax-exempt interest and rent of $25,000 each, $5,000 of property taxes, and a total commissions paid out of $3,900, of which the trustee has made the decision to allocate $1,300 to principal. Under the accounting rules, capital gains are excluded from income since they're allocated to principal, and only $2,600 of the commissions are reported since $1,300 goes to the principal, leaving a fiduciary accounting income of $92,400. For the tax return, you must first calculate the distributable net income, or DNI. The capital gains are still excluded, but the indirect expenses like commission fees must be allocated between the tax-exempt interest and the taxable income, leaving a DNI of $91,100. On the tax return, the capital gains are shown in income, since all income is taxable unless excluded from tax. The tax-exempt interest, being non-taxable, is not shown, leaving a gross income of $90,000. Only $29.25 of the commissions are deductible, since the remainder is allocated to the non-taxable interest, and a distribution deduction of $67,075 is shown. This is calculated by taking the DNI less the tax-exempt interest on a net basis, or by taking the taxable income of $75,000 and subtracting out the deductions that are allocable to the taxable income. This leaves $14,700 of taxable income on which the trust will pay trust-level income taxes. If you have questions about trust accounting or need help filing a trust return, give the tax experts at AA Accounting a call. We're available year-round to assist you, and we look forward to hearing from you.